Index funds, the great democratizer of Wall Street, have grown to be the dominant force in investing. Unfortunately, there are some maybe unintended consequences and clear risks that are emerging. And some bad people are hijacking the industry, putting your wealth and our nation's future at risk. In the first segment, we talked about the very real benefits of being a passive investor. Passive investor buys an index fund and really invests in the entire sector of the economy or maybe the entire market. Since the index fund phenomenon began in 1976, it has taken Wall Street and investors by storm. In less than 45 years, index funds have surpassed all traditional mutual fund assets. And they've outperformed the vast majority of actively managed funds by a decent margin over the long term. We expect that if the stock market continues rising, active funds will continue to underperform. But the first risk you should be aware of is the risk of a market decline. Passive investors will make a great case that the market has always bounced back. And betting against America and our stock market is a loser bet. They may be right, but the reality is that there are many forces at work today. With the market at all-time highs, this could be a real threat, especially with a risky political environment. Those who love index funds will quickly counter. There have been plenty of threats before, like a Great Depression, World War, other wars, severe inflation, terror attacks, pandemics, and political upheaval. Yet despite these problems, the stock market is higher today than any point in prior history, and that's a valid point. But it also demonstrates one of the counterpoints. If you take a measurement when the market is an all-time high, it's always going to favor passive management. But depending on the time period, if stock prices are down sharply, as does happen, active management can and does look better. Remember the Wall Street adage, past performance is no guarantee of future results. So starting with the market at an all-time high, if we see a drop from here, you can bet that many active managers will beat the market because they will hold selected stocks, some hedges, and cash. If the market rallies to new highs later, of course, the passive managers will again take the lead. Now, we can debate individual performance all day, but you should know that a falling market is at least a short-term risk to owning an index fund or index ETFs. There are other risks, and these get worse than just taking a short-term loss. Just Google index fund threat, and you'll see a whole host of articles in reputable publications debating whether or not the extraordinary success of index funds threatens the overall market or economy. Now, let me read a few headlines. Bloomberg, the hidden dangers of the great index fund takeover. Forbes, are index funds a threat to your wealth? MarketWatch, index funds may hold more danger than you realize. Seeking Alpha, the danger in index funds. U.S. News, has passive investing become fraught with risk? Math Investor, does indexing threaten the market? Now let me summarize these concerns these recent publications are raising. First, there are some who believe that index funds are a big, self-fulfilling bubble. Michael Burry, now that's the guy behind The Big Short. He's one such believer. Here's what he said in a 2019 article in CNBC. He said, passive investments are inflating stock and bond prices in a similar way that collateralized debt obligations did for subprime mortgages more than 10 years ago, Burry told Bloomberg News. Like most bubbles, the longer it goes on, the worse the crash will be, said Burry. The theater keeps getting more crowded, but the exit door is the same as it's always been. All this gets worse as you get into even less liquid equity and bond markets globally. Burry makes some strong points, and the market has gone even higher since he made them. If this is a bubble, it's only gotten worse. And remember, this is a man who saw the risks of the housing bubble and made a literal fortune because he was ready for it. But as bad as that is, it's not the only concern. There are others who believe that the popularity of indexing threatens our entire investment structure and the efficient allocation of capital.